Both Michael Barr and Neel Kashkari seem concerned over the U.S. financial system after the collapse of Silicon Valley Bank. For more on this, we're joined by Vincent Reinhart, Dreyfus and Mellon chief economist and former director of the Federal Reserve's Board Division of Monetary Affairs. Good to see you, sir. So let's start there with those comments from Barr that this is typical mismanagement. Is it far more than that, sir?
Okay, two parts. The first thing is, who are the Nobel laureates in economics right now? Diamond and Vig, who established that bank runs can matter. And what do you need? A maturity mismatch, deposits that are uninsured, and a trigger like trying to raise capital. SVB fits that textbook perfectly. Third one is Ben Bernanke, who said that a deposit run could lead to financial contagion and that could hit economic activity. That explains the response of the major regulators trying to contain the damage. What didn't we hear? Any self-blame. Importantly, in that mismanagement was being lulled into by a decade of the short-term interest rate being very low, and completely inert to invest in longer-term securities. That turned out to be completely inappropriate as the Fed tightened. So part of what's happening right now is a legacy of lower for longer.
Well, Vincent, what does all this, though, mean in terms of the risk here to the economy, in terms of the risk of a recession? Kashkari making the case that it raises the risk of a recession. Do you agree?
Yes, but you have to pick your starting points. Back in January, people were talking about the recession of 2023. Every major indicator of recession was flaring. Then we got a string of strong data, and if anything, it suggested that the odds of recession had gone down a lot. We heard about no recession and soft landing. What the events of Silicon Valley Bank and the run generally have basically trimmed the good news we've heard since January, and we're back where we started. Chair Powell said that in his press conference last week. So essentially, where were we in January? We were thinking the Fed would tighten a couple more times and that there would be some risk to the economy, considerable since their forecast was a 1 percentage point increase in the unemployment rate, something that doesn't happen outside a recession. So we're back in January. Is the risk of recession higher? Yes, it is higher than when employment printed with, close to 300,000 jobs created, but it's not materially different than where we were in January.
I want to circle back quickly to the Barr comments. Again, placing all the blame solely on the bank. You recognize, and you just mentioned the backdrop that the Fed created of a rising rate environment. But what about the Fed's inability to see this coming and to better regulate SVB? Should they acknowledge that?
So that's why they're doing a report. And so my answer will be a lot like Chair Powell's answer at the press conference. Premature to weigh in before we hear the report that the Vice Chair Barr puts out. You recognize that the regulatory and supervisory process is a lot of memo writing. They send warnings to banks and expect banks to follow up. An important question for the vice chair, an important question for the FDIC as well, is how do you make sure banks act on that advice? That's part of the private sector system we work on. Regulators watch, they advise, but it's up to management to put meaningful changes in place. It appears that the folks at SVB, at least according to the vice chair, didn't.
And Vincent, a lot of people are asking the question what SVB's collapse with the recent comments from Powell at his press conference, what all this means for Fed policy going forward. We asked one of our guests last week, Chris Leonard, about this, about what he thinks it means for Fed policy. I want to play this quick soundbite and then get your reaction on the other side.
what Jay Powell is telegraphing and what the entire FOMC is telegraphing is that we are going to see rates at or around 5% for the rest of 2023. And that is going to have significant, knock-on effects in financial markets. It is hard to envision a world where we stay at 5% for the rest of 2023 without having massive downward adjustments in asset markets.
Vincent, what do you think is an appropriate response from the Fed going forward? Is another hike likely on the table?
I think they're leaning forward, and particularly in an environment of considerable uncertainty. They don't know what the neutral funds rate is. They can't fine-tune anything. So the policy design is to put the funds rate at a level that is meaningfully restrictive and then hold it there until they get evidence that inflation is gone back toward the goal of 2%. For them, that restrictive level is probably a quarter point higher than it is right now. So expect another tightening at the May meeting. And they'll hold it there until they're convinced otherwise. And remember, once a central bank stops, they tend to linger a while there, just as in the chart you're showing right now. Long period of pause in between policy actions. And that's true if you ran this chart back to the 1950s. And that's where the Fed is, because they believe that the financial contagion is limited, because banks basically are well capitalized. This was a relatively unique phenomenon of the tech culture, and that the policy response has been pretty vigorous.
All right, Vince Reinhart, always great to get your perspective. Thanks so much for joining us this afternoon.